Welcome back to Simply Money. On our last video, we talked about JEPQ and how the backtesting panned out, looking at it for the last couple years. If you'd invested $50,000, where you would be at today. As promised, we're going to look at SCHD, one of the most popular dividend growth funds that's out there. This ETF has become very popular with dividend investors, with dividend growth investors, and with those that want value growth. But how does it really pan out? Is it all that it's cut out to be? Has it performed as well as other dividends could? As with all of these videos, it's for educational purposes. I am not a financial advisor. This is not a recommendation on buying or not buying SCHD. I'm just showing you what the performance was and speculating on what it could be. And remember, when you're in the stock market, there's going to be ups and downs. You need to know what is best for you. You need to know what is your goal and what kind of investment strategy you want to have. Are you risk averse? Are you willing to take more ups and downs? Are you willing to see higher highs and lower lows? Everybody has a different story, a different financial situation, and different goals, and you have to make that determination for yourself. I can't give you advice. Even a professional financial advisor can't tell you what you should do. They can guide you. And especially they can't tell you what you should do and guide you without sitting down with you, because your situation is unique to you. So without all your personal facts, there's no way to give a one-size-fits-all recommendation. So take that for what it is. Keep that in mind as you look at this and as you make your decisions. Do your homework, do your due diligence. But remember, whatever you do with the stock market, don't let your emotions keep you in and out. Make a commitment to the long-term investment strategy. Doesn't mean you won't make changes, but it shouldn't change just because the market is up or down, because that's going to happen on a regular basis, as you will see. Let's dive right in. Here on my screen, you can see if we had invested on March 1st, 2017, $50,000 into SCHD at the time, it was selling for $45.05 on that day. That would have purchased us almost 1,110 stocks, just under. Those 1,110 stocks, as you can see, obviously the $50,000 value. Because we're not dollar cost averaging, we're not adding to this, it's a one-time lump sum, $50,000. Perhaps you came into an inheritance. Perhaps you sold some of your growth stocks and you want to now put it into a dividend growth and have some income coming from that. Perhaps you had a house rental or something and you sold that and you have this lump sum. We're using this scenario. We'll do some other videos on some dollar cost averaging to see how that pans out with these different ETFs and which one performs better with the dollar cost averaging approach. But we want to use the JEPQ, we use 50K. This one we're using 50K and we're starting from 2017. So we're going back 7 years right now as of this video. The first dividend would have been paid on March 24th. So you just bought in prior to the declaration of the dividend. And so you're able to collect that dividend on the 24th that pays out. And that dividend paid 33 cents per share. And you had these 1,109 shares. The dividend payment would have been $361.60. So the dividend payment is $361.60. As you can see, the stock price is $44.55. It's down a little bit in the 3 weeks. Again, this is the roller coaster ride of the stock market. It's up and down. You didn't buy it just for 3 weeks. If you did, you're in the wrong investment plan. But because you got this dividend, now you can buy 8 more stocks. You have your DRIP, Dividend Reinvestment Plan, DRIP, turned on. So that automatically buys 8 more stocks or ETFs. And now your total ETFs is up to 1,100 and almost 18. But your value is down slightly because the stock price has dropped slightly. Again, we're going to watch this up and down along the way for the next 7 years on this back test. So let's go down and we'll skip down to the end of the year, December 22nd of 2017. You've been getting your dividends, as you can see, for June, September, in December of that year. You get paid quarterly on this ETF. Unlike JEPQ, which is a monthly dividend, this is a quarterly dividend. It pays on those quarterly dividend dates. You can see that it went 33, 33, 34, 34. So it hasn't grown much. It went up 2 cents at the end of the year, or 1 cent each time, so 2 cents. Now your dividend on the December is up to $391. Even though you only went up 1 cent from this first dividend, you've gained $30 because you've been buying. Every time you got the dividend, you buy more shares with the dividend. About 30 stocks, ETFs, because you've been reinvesting this dividend. That is a great way to show how the dividend snowball is beginning, even in this early stage, to increase the amount of dividend you're getting. Even without a growth of the dividend, you're seeing a growth in that. And look at here, your ETF price has gone up to $51.16. So now you have 1,142 ETF stocks. Again, I always refer to it as a stock because it is a stock. It's one stock called SCHD, which compiles all of these other stocks within it. It's just easier to say you have this many stock of SCHD. Now your value, you invested $50,000. And this year you've gained $8,429 in value. That is a nice early on growth because you invested the dividend. There was some growth in the value, but a lot of it has come because you've been getting these dividends. You have about $1,400 worth of dividends that have been paid to you in this first year. Let's skip down a little bit. We're coming down here to the end of 2019. So now at the end of 2 years, you can see the dividend, even though it went down here at the beginning of 2018, they also went up in these subsequent quarters. For the year, you've gained in how much dividend you get. You can see this payment was a little bit lower, $298, but then we jump up to $465, $424, and $472 in this year. Then look here in 2019, you're up to, at the end of 2019, you have a $578 and a $560 dividend payment coming because the dividend has gone from 33 and 34 cents that first year to 49 and 47 cents at the end of this year. And the stock price has gone up as well. With that higher dividend, you're able to purchase 9 and 10 stocks each of these dividend payments. Now at the end of 2019, you're up to 1,202 stock. You've gained almost 100 stocks in this 2 years. In your value, $69,000, almost $70,000 is your value. You've gone up $20,000 in this ETF. But watch, this is where you have to be patient. Let's scroll down here to 2020, COVID. We all know COVID wreaked havoc on the stock market for a short period. In March would have been a great time to invest. The market dipped for a very short period, very hard drop. People were panicking. People were afraid. Fear drives people out of the market. That's why it's good to tune out of MSNBC and these other financial shows that just push and push fear. Yes, we have inflation. Yes, the stock market goes up and down. Yes, there's things happening in the world. It's been going on since the stock market's been around. And it has averaged 10% over the course of its history because it always rebounds. So let's look at March 2020, COVID. Look what happened to the stock. It went from 57 down to 44. Your value dropped from almost 70,000 down back to 54,000. So from your prior quarter, in 3 months, you dropped $15,000. So you're looking at your portfolio and you go, oh my God, I'm losing all my money. The stock market's crashing. Stop and think for a minute. Take a deep breath. From when you invested, you still have almost a $5,000 gain. Now, that's not fantastic. That's not amazing, but you would have still been up in value $5,000. You haven't lost anything because you haven't sold it. This is still sitting there. But look what you have gained. Now, instead of owning 1,100, and what was it, 1,110 stock, but look, instead of now owning 1,109, you own 1,224. You have gained that many stock, even though the price is down and the value from its high is down, you're still up. But because this value is down, look, your dividend isn't much lower, $535 compared to where it was. In March of the year prior, you got a 35-cent dividend. In March of 2020, during the pandemic, you got a 44-cent dividend. Yes, it's lower than this, but that's SCHD. Their March payment is typically lower. From March to March, you got a 9-cent per dividend raise. Because you own more, instead of $413, you got $535. And because the price is down because of all the panic, you're able to buy 12 versus 8. So you were buying 4 more stock that quarter off of the dividend, but increases the number of stocks you own. Let's look at the end of 2020, the end of the pandemic. Everything kind of settled down in June, September. You see, June, the price goes up to 50, up to 55 in September, and then the end of the year, it's all the way up to 63. It reached a new high. So all the panic, all the fret. And look at this. The 44-cent dividend grows to 54 cents and 60 cents. Now you're getting a $750 payment on that December dividend. That is double what you were getting when you bought it 3 years earlier. You have doubled your dividend payment, more than doubled, and you haven't done anything except reinvest the dividend. You turned on the drip, you sat back, and you didn't watch it. And look at here, you were freaking out in March. Oh, I'm losing, everything's going, the market's crashed. Chicken Little, here you come. The world's ending. Boom. End of 2020, you're up to $80,000 of value. Again, you don't have that because you're not selling it. You're watching it grow. From when you bought it, the course of 3 years, you have gained $30,000 of value. If you didn't panic and freak out and sell everything, just like a lot of people do because the market's crashing here in March of 2020. Imagine if you didn't panic and when everyone was freaking out, you said, this looks like a great opportunity. I'm going to buy some more. And you invested some more during this time frame. We're not doing that on this scenario, but imagine if you did. You bought it at this low price because everyone's freaking out and you would have got a great buy because now the value's up to $63. We're going to skip down a little bit further here before this video gets too long. I'm going to look at the very end of this chart, December of 2023. As you can see from December 2020, the dividend payment, again, March, it's the lowest of the year for them, but it goes up. So in December of 2021, it's up to 62 cents versus 60 cents. December of 22, it's up to 70 cents. December of 2023, it's up to 74 cents. Look at this dividend payment. You started out your first payment, $361, $370. Now down here, 2023, $800, $900, almost $900 again, $1,000. This year, look at that dividend payment. You haven't done anything. You've just let the money ride, and it's growing because it keeps investing dividends. Your total stocks now that you own, almost 1,400, 1,393 stocks because you have been buying more stocks. And look at that. As you get this higher dividend, even though the price is much higher than its original, you're able to buy 14 more stocks. Since 2017, in these 7 years of investing, you've gained 283 more shares just by reinvesting. Your value is $101,000. You have doubled your money in 7 years. You've doubled your value. If you sell out of this, you've doubled what you invested. $51,000 would be your gain. You could just sell this out, and boom, you had a $51,000 gain in 7 years. Doubled your money. You have been gaining. You gained $17,000 of dividend payments that were reinvested, bought you these 283 shares, which added to this growth. but the share price has also grown 61%. Now, this is at $72. This was the end of December. As I'm making this video today, it stands at $79. We'll do another video next year to see how 2024 ends up and where this is at. We'll do that with all of these. We'll do an annual every year between January and March. We'll do a recap of all these funds we're looking at and how they have panned out as we add the additional year of your $50,000. Now, is that the best? Are there other funds? We're going to look, as you can see down here, we're going to look at VYM, DGRW, SOXX, a semiconductor ETF. Wait till you see this one. SCHG, SPY, QQQ, some of these most popular funds. Some of them are your S&P 500. Some of them are tech with the QQQ. SOX is all tech, but it's just semiconductor ETFs. You have all these different philosophies or indexes that are looking at how they grow. But the good thing about this fund, if you look at it, there have been some downs. You can look at 2022. We know that was a rough year for stocks. It went from its high here, 79. It got down to 67, but then it starts climbing back up. The whole stock market was rough in 2022. SCHD hasn't recovered as fast as like the S&P 500, but that's strictly because of the Magnificent Seven, particularly NVIDIA, but it's still climbing back. Again, in the last 3 months, it's gone from almost $73 up to $79. It is long-term going to grow. Again, depends where you're at in your investment. If you want less volatility, then say SOX or QQQ. SCD is a great way to, you're not going to get as high, and you'll see when we do these videos, check out those when they come out. Make sure you hit the subscribe and notify button so you see when SOX comes out and you can see the amazing growth that that's had. And see, does SCHD do better than VYM or DGRW? Hit that notify button so you see when it comes out. If you find these videos interesting, you like seeing this back testing and seeing it quarter to quarter or month to month, the dividend and the growth, hit the like button. Let me know that you appreciate it. Throw me a comment again on what stock or what ETF you want to see back tested so I can do a video for you. I'm excited to provide these for you. I love looking at this. It visually lets you see the prices. Look at this, $55. We're freaking out. Oh no. But now we're up to $72, and as of this video, $79. You are in the stock market for long term. The problem a lot of people have is they're so scared. Two spectrums. Don't gamble. Don't try to day trade. Don't try to quick buy and sell to try to make a big killing. That's how you lose money. But also don't let fear keep you from investing in solid, safe investments, diversified. SCHD has 100 holdings. It has Broadcom. Well, not anymore. It doesn't have Broadcom anymore. Reconstitution took place, but it has 100 stocks. I'm not going to go through reconstitution. It has 100 stocks making that up. So it's got a diversification for you. So you're not putting all your eggs in one basket. And you shouldn't hold necessarily just one ETF. You should have a balanced portfolio of an ETF that's not overlapping a lot, that provides you a great diversification, a balance of income and growth and cornerstone. You have to find what works for you. But ETFs are a great way to diversify. I don't want to put all my money into NVIDIA because it is one stock. It can go up and down. It can crash. You may not recall back in the day, the Nifty 50 comprised places like Sears and Kodak. They are no longer big companies that drive the S&P 500 or the stock market. Now we have the Magnificent Seven, NVIDIA, Apple, Amazon, Microsoft. Those companies are huge now, and they're driving the front end. They are the engine of the S&P 500 train, but they are still a single stock. So be careful in how you invest. And that's it for today. SCHD over 7 years. See the performance. You want to double your money? It did it this 7 years. Will it do the next 7 years? We don't know. Look at it. Give it a thought. And tell me what you think down below. Is SCHD a good investment for the next 7 years or not? And we'll see you next time on Simply Money.